Welcome to another episode of The Human Side of Wealth. I'm Andrew Buza, Director of Financial Planning at RWA, and I am very excited to be joined by two of my colleagues today. So I've got two Steves with me. I've got Steve Johnson and I've got Steve Reeder. Gentlemen, welcome.
Thank you.
Thanks for having us.
So, President of Private Wealth, you've been here before.
I have.
This is old hat for you.
Absolutely.
But Steve Johnson, this is your first episode that you've done with us.
Very excited to be back on TV.
Yeah. Oh, I like it. So you're a wealth advisor here and also a portfolio manager.
Yeah, one of the great things about RWA in my role is I get to wear both hats.
Yeah.
So I get to advise clients on their planning and their allocation, but I also have a say as to what goes into the allocation and what are those investments.
Very good to have you alongside for the ride today. And so today's episode, just to set the table, if you've listened to some of our past episodes, we've talked a lot about the four pillars how we approach our client service. So we think about financial planning, tax planning, estate planning, and investment management. We haven't really done a deep dive into the investment management side of the world here. So that's what today's all about. Today is about covering that pillar, investment management, how we think about it, how we implement it as part of a financial plan. And if you have questions as you're watching this episode, please go to rwawealth.com. If you click on the contact button, that'll get you in contact with one of our advisors here. We'd be happy to help with any questions that you have. So, guys, let's get into the episode. I first starting off with a broad question, Steve. As you think about, I'll say Steve Johnson, since we've got two Steves. When you just think of the broad term investments, right, and we're thinking about public perception here, how do you sort of square that up when you're talking with a new prospect or a client that might have some notions about what they think about from a portfolio standpoint?
Yeah, I think we try to keep it pretty basic.
Yeah.
So I think we're all familiar with the term stocks and bonds.
Yeah.
And I think what we do in this business sometimes is we get too complicated. We confuse people. We talk about large cap and small cap and international and micro, whereas we just want to make sure that people understand the big picture.
Yeah.
So what is your risk tolerance? How does that portfolio fit with how much do I want to have in stocks? How much do I want to have in bonds? And how much do I want to have in cash?
Mm-hmm. Yeah.
Mm-hmm. And as part of our four pillars, Steve, maybe tee that up of where investments kind of fits in your head.
Yeah, for me, it's really difficult to get a proper asset allocation if you don't have some knowledge on the financial plan.
Yeah.
And so understanding what's their financial picture look like, what are their goals, what do they want their life to look like? Because that's going to really determine a lot of the risk factors, how risky we could or should be, as well as a lot of the allocation, which I think is going to really be the thing we're going to focus on, is making sure we have the right allocation for the client based on the life they want to live.
Yep. So what I thought we might do today, sort of as part of the episode, is kind of think about investing and financial planning, how they really can't exist, without one another. Sort of to your point. And so, sort of if we start on the investment sort of side of the table, why is it so difficult to do that in isolation if you don't know kind of someone's broader financial picture?
Just the basic piece is if I don't know you, how can I recommend something? So if I go to the doctor's not going to prescribe me a statin if I have a knee problem, right? And so I think one of the big mistakes that clients have as well as advisors is they're very quick to prescribe a solution. So you need this product or you need that. And so what we try to do is take that bigger picture. And so understand what your plan is. Understand what are your goals? What are your objectives? Do you have a major spending issue in 3 years? Do you have children graduating from college? Thankfully, I just wrote my last check. My daughter's graduating. So I know, thank you. I know that's a piece that I no longer have to worry about. And so maybe my goals and objectives are different going forward than someone who has 3 children in middle school or like you, just not even in preschool yet.
That's right. Almost a 1-year-old. Yeah. Starting to save in that 529, that college savings. And so on the other side of the table, right, let's say you've established your financial plan,
Mhm.
then how do you start to then kind of fit investments in? Sort of another way of asking, like, what's the risk of sort of not having the correct sort of investment or asset allocation if you have sort of the rest of your financial plan in order?
Yeah.
How do you think about that?
Yeah, it's a big part of its timeline.
Yeah.
And so when I think about when someone's going to need the money, that's
Mhm.
going to definitely have a big impact on how we're going to invest the money. And so understanding if they are saving for, you mentioned 529, if their child is 16 years old and they're looking to pay for college, or if they're 2, there's a big difference in how you think about the investment piece of that.
Mhm.
And I also think, our industry has done probably the client a disservice in many ways, the way we've talked about it as an industry, and what we focus on the overperformance. But I think the reality is we want to make sure that it aligns with their goals. And so if we're investing them in what should be the best investment in the world, that is in a vacuum if you're not looking at their goals. And so Steve and I are both old enough that we lived through the 2000, 2001, 2002 in the industry. And you saw at that time where not only did people's investments misalign, some of the mutual funds out there were misaligned. You have, the value funds dropping much more than they should have when you saw the tech bubble burst. So I think it's really important that you just stay aligned with what their goals are and make sure that investments appropriately match. And some of that you just learn through experience too. It's hard to teach some people that, and especially in the heat of the moment when this AI is running, everyone wants to be part of the Mag 7, but it's just not appropriate for everyone to have a major allocation into those.
To expound on that point, I think we're at a real crucial point as it relates to the market, someone's investments and their plan, because years ago everyone just thought about beating the market, right? And so I need to beat the market. I have a number in hand. I need to get X percent better than my neighbor.
Yeah.
Well, that temptation today is off the charts because think about it. We've had a 17-year bull market, so we've had some declines. You had COVID. You had 2022, but the market has had a V-shaped recovery. So if we did your plan 10 years ago, you had X amount of dollars, you got a lot more dollars today. And so what that means is, to Steve's point, is if you get a larger decline, that's probably going to hurt a little bit more, right, in terms of that plan. And everyone is focused on just the winners. And so when prospects and folks come to see us, their portfolios are very similar. Yeah. So everyone has those names that have been incredible wealth generators, right? We know the names and they've done so well. And so there's this reticence to either sell them or to diversify. And we think that's why that plan becomes even more important today, because we want to know not only what's their risk tolerance, but what's their capacity to take risk. And right now, I think we've kind of all forgotten about drawdown and what things could happen. And so making sure that that plan aligns with the existing portfolio is very important, especially as, God, there are levered ETFs. We have 0 days to expiration options. I mean, everyone's got a Robinhood account, a Kalshi account. So all of the temptations are there. I would argue it's so much easier for investors to really have their plan disrupted by all of the temptations that exist out there. And it's our job to kind of pull back the temptation, make sure that they're grounded in understanding kind of what the portfolio can do.
Yeah. Well, kind of to your point, right? I think maybe there's this temptation to overcomplicate. And there has been this democratization of investing, right? It's a lot easier to access. It's easy maybe to feel like you can do it yourself. And so I want to pull on that thread. When you're meeting with someone new, there has to be so many preconceived notions of what maybe their investments should be or what they've done, right? Maybe they've had winners that have sort of got them to a point. We did a previous episode on concentrated positions specifically, but how do you start to shift that mindset of, okay, what you've done may have been successful, but kind of here's how we think about our philosophy here at RWA.
Yeah, I think that is where the plan comes into play, because you can show them really what if.
Mm-hmm.
So what if inflation stays at 4%?
Mm-hmm.
What if your expenses because of healthcare go up by 8% a year? And what if we do have a bad market? Like, what does that mean for your portfolio?
Mm-hmm.
And I think it's really more of just about education. One of the things I always tell folks is, like, we don't think $1 million is a lot of money anymore, right? I don't care where I came from. $1 million is still $1 million, right? It may not be 10, but it's still a lot of money, right? And so for those clients, reminding them that they've done such a fabulous job of accumulating this wealth, and our job is to preserve it. Right? It's not to double it in 2 years or to buy you the hot stock. It's to make sure that that wealth is there for you to pass on to your children or to achieve any other goal that you have or to pass it on to charity. It's really about what you want that money to be.
Mm-hmm.
Yeah, I think a big part of what we do almost is being an accountability partner is how I think about it. And everyone has their biases. And so if a client comes to work with us and they are naturally fearful of the market, it may be the opposite of what we're talking about, where they may have to work till they're 80 just to get enough money because they aren't investing their money. They want to stay in cash. They're going to be super conservative. And so those biases go both ways. And I think we see as many people who are fearful of the market. And so in the times we're in now, where maybe there's some scary headlines in the news, people want to jump to cash. And that's rarely been the right move, and it's really difficult to time when the right time to get out is and then when's the right time to get back in. And the accountability partner side of it is I've seen clients over the years who have made the decision they want to go to cash. It's really hard for them to get back in. And so if you have someone that's maybe not as emotionally attached to that, that can give them more of an outside perspective. I mentioned earlier, but some industry experience and knowledge and living through some of these things makes a big difference. Will help them get to a better solution, because whether we realize it or not, like, money is a very emotional thing for a lot of people, and making these decisions can be driven by emotions many times.
Yeah, and removing, to your point exactly, removing that emotion, but also our job is to make sure that that portfolio is well constructed, so that there aren't any major holes, so that they don't have that massive concentration risk, so that they're not focused in one sector, making sure they have enough cash to not panic if the market it does go down, or make sure that they do have enough of an allocation to growth. To Steve's point, if they're like me and probably too fearful about the market at most times. So.
Well, as you mentioned, we all have our own biases, and a lot of this is also informed by when you grew up, right? What the market was doing at the time that you were accumulating, earning money, whatever the case may be. But how do you handle a conversation, right? If a client calls you and they're fearful and they want to go to cash, how do you sort of have that conversation? What do you go to?
Yeah, I think for me, it's more about understanding the situation. Like, know who your client is, because we know we have different types of clients. Some that are much more emotional, some that want to buy every dip, right? So for them, it's a buying opportunity, and for some, it's oh my gosh, I need to get out. So it's really understanding your client, knowing what type of person they are, but also being able to reassure them through guidance and also the experience that we have, knowing that we've been through this 2000 period, the 08, 2020, but also reassuring them that their portfolio was built to withstand the turbulent times, and that's why we do have the plan, and that plan is in place so that they don't necessarily have to, be wildly successful in that time of timing the market, because we know that that's very difficult to do. And so they're not going to be able to time it. We want to ensure them that this is obviously a long-term plan, but we have built the portfolio really to sustain those difficult times.
Right. Well, as part of the financial plan, I think, as you mentioned, that's why that's really the foundation, kind of tying back to the 4 pillars. That's a lot of times where those conversations end up as well. Let's see how you're doing from a long-term standpoint. I think it's very difficult, right, in our news-driven world, right? Headlines are grabby. They get your attention, and it can sort of make you fearful, whether you are someone who feels that way or not.
Yeah, I think the other reality that we see a lot today is The markets have largely gone straight up since 2009.
Yeah.
There's been some dips in there, but I mean, 22 was the worst, but that was short-lived, relatively speaking. So when you're in a market that's gone straight up, you get the other side of it, where people have all these assets that have majorly appreciated, and they've done so well, and so they get attached to them, and they don't want to sell them, but then they also have these tax implications. And so there are times when we'll talk with a client who starts to get fearful, and you get into their portfolio and it's like, yeah, let's talk about your goals. Their goals get misaligned because of their success. The market has been so successful for them that there's a misalignment. And I think that's another spot where, I think a great conversation with an advisor is really important to understand, how do we start to unwind some of this? What are the risks we are taking if we choose to stay in more of a concentrated position? And I know taxes, nobody wants to pay taxes. Nobody likes to pay taxes. But there's a balance there when you look at the plan. If they're looking to retire, it's going to cost us some money in taxes, but if we diversify this and get a more stable portfolio, you probably will sleep a lot better in retirement if you get a better aligned than if your portfolio is, largely in technology because they've run up so much. And so we become a little bit of like the victim of success in these types of markets.
Yeah, protect the win.
Mm-hmm.
But I mean, as you guys mentioned, the financial plan is so important because that's your target, really, at the end of the day, right? I'm sure. I mean, you may have talked to clients or prospects who say, my goal is to beat the S&P. That's not really a goal, right? Or versus, and it just sort of maybe talk about that.
Yeah, I mean that's a very difficult goal.
Yeah,
right,
yeah.
and one that 99% of the folks never achieve.
Yeah. Why do people feel that way, you think?
Well, I think because there is this mindset that you always want to do better than the next person.
Yeah.
And that everyone overestimates our own intelligence.
Yeah.
I'm guilty of that as much as anyone. And so we all think we can do better, right? We think it's easy. And to some extent, to Steve's point, people have actually, right? Because they've held just 4 names or 5 names, and so they don't understand what comes with that. They don't understand the commensurate risk they're taking by building these types of portfolios. And so, yeah, I mean, beating the S&P is a goal if you're a hedge fund manager, right? And you're getting paid to do so. But it's more about, how does your portfolio provide for your way of life? So sometimes I think of investing as just another way of saving, right? So you think about it, back in the day, in the 70s, you were getting 13, 14% in CDs. Now, granted, inflation was also double digit, but that was a great return for some people. And so the way you think about it is, I need to achieve a certain percentage to achieve my goal. And is it owning more equities? Is it owning more bonds? Really, that's the conversation. And so beating the S&P isn't really the goal you should be looking at. It should be, I need to get $50,000 for my portfolio because that's going to provide for my family. That's going to pay for college. It'll allow me to buy a new car or to move to Florida. So those are more about the conversations, and those are ongoing. Especially now, I mean, people have made a lot of money. And so the plan is probably a lot more successful than what it was 5 years ago. So being able to sit down and have that discussion now, I think is very important, because you don't have to beat the S&P anymore to achieve your plan.
Right.
And by trying to beat the S&P, you could end up in a much worse situation.
Yeah.
Yeah, a question I like to ask people is, what goal is so important that you're taking this much risk? Because you do come across a lot of people who, they have enough. And you look at the plan, and the plan is imperfect. Let's just I want to make sure we don't misrepresent. Like, a financial plan by nature is a guidance, but it is imperfect. It is, however, in my opinion, the best tool we have to judge whether or not someone is on or off track. So it's not going to be perfect. It's directional, but it is the best tool that we have. But if we're showing that you're highly likely on track to meet your goals, to live the life you want without running out of money, why are we taking all this additional risk? If we can pull some chips off the table here, diversify, get a little more conservative, and you still get to live the life you're looking for, why are we taking all this risk? And I do think, that hopefully is a good question people can think about as like, okay, why do I still have so much Apple, Nvidia,
Yeah.
pick the name, in my portfolio if I've got enough?
Yeah. We've covered a lot of good ground here today. I've been liking to end these episodes with maybe one key takeaway that you have as we kind of think about the investment pillar here at RWA. What would you leave the listeners with?
For me, it's know what's in your portfolio and know what your risk is, right? Know what that potential drawdown is and understand how it relates to your financial plan.
I like that.
I'll take the other side of that, which is the planning side of it. So I'll say, know what your goals are and understand what they are. And I think it takes a great conversation with yourself, maybe your spouse, whoever, but just what are you hoping to accomplish? Because the more clear you get on what you're trying to accomplish, the better suited we can make an investment portfolio for you.
It's well said. All the pillars work together. We've covered all of them now, right? So we've talked planning, we've talked investments, estate planning, of course, and tax planning, right? None of them can live in isolation. They all really need each other to build a overall successful wealth management plan for somebody. So Steve and Steve, great to have you both on today's episode. And congratulations again on that graduation that's upcoming.
Great, thank you.
We'll have to figure out how to allocate those extra funds.
Exactly.
That you've got. So a lot of good stories today as we think about the human side of wealth. That's what really it's all about. It's about your goals, your objectives, what you're trying to accomplish with your money. It's not about beating a specific index. It's really about the financial plan and how your portfolio ties into that. So if you have any questions about what you heard today, please give us a call at 617-321-2200. We would be absolutely happy to help with any questions that you have about your financial plan. Thanks again.